Good morning. It's Peter Stimson here, Head of Product at MPowered Mortgages. This is just one of those occasional videos we do when something happens in the mortgage market and we think we can probably impart a little bit of information. This morning, as you're probably aware, CPI has dropped and it's come down to 1.7%, which is good news because it's below the government's 2% target, or the Bank of England's rather 2% target. CPI is obviously very important because it plays out and is one of the key metrics in how the Bank of England decides what they're going to do with regard to bank base rate. Bank of England meet again on the 7th of November, and this probably means that we're going to get a bank base rate cut. We think it's going to be 0.25%. We think it's unlikely that it's actually going to be anything more than that, simply because last time round it was an 8-1 vote in favour of holding bank base rate, and also because we think there's strong inflationary pressures which are going to push CPI up again in the months to come, simply because obviously the energy price cap is going up and fuel is likely to go up in the months ahead given what's going on in the Middle East. So we think it's likely to be a quarter rather than anything larger than that, and a quarter has already been priced into the swap curve for the months ahead. Talking of the impact that it's likely to have, so assuming we get a 0.25%, this morning, what's happened in the markets? Well, swaps have fallen by around 10 basis points, which is good news. The probably slightly less good news is swaps had actually gone up around 18 basis points in the 2 weeks or 10 days preceding that. So swaps are down, but they're down from a position of where they'd gone up in the preceding 10 days. We've actually seen some lenders already increase rates today and in the preceding 2 or 3 days. And I think you're probably going to see lenders actually still increase rates the next 2 or 3 days ahead, simply to account for the fact that margins in the market are actually incredibly wafer thin at the moment. I've been doing this job, as you can probably see from the grey hair and the wrinkles and the sort of very worn expression on my face, for 20 odd years. And this market is the most competitive I've seen it in 20 years. Lenders normally start a year with a lending target of how much they'd like to lend in a year. This year has been a very slow year. Purchases are down, but significantly from where lenders would like them to be. And lenders are trying to make up a lot of ground from where they've been, particularly in the autumn market, and they are lending at very, very, very low margins. That's not sustainable long term. So, ultimately something has to give, and it's probably going to be some of the pricing and some of the margins at some point. So, margins are probably going to have to start being pushed up again at some point by lenders. So, despite the fact that swaps are dropping off, we don't see the fact that we think pricing is going to come down on the mortgage side of things, despite the fact that, we're probably going to get a BBR cut in November. Because like I say, the markets were anticipating probably a BBR cut in November/December. So, good news, the fact that CPI has come down, and we're probably almost nailed on now, I think, for a November cut. But, we don't see the fact that, we are going to see any change in fixed rate pricing because of that. And you may even see a slight tweak in some increases from some lenders as a result. So that's it from our side of things. Enjoy the rest of your day. Thank you.